it sucked. Is that literal enough for you? Volatility, like years ago, it was brutal for a very, very long period of time. So I'm actually going to bring up the VIX. And I got to say this again. I'm not like a proponent of the VIX. Like, I don't really look at the VIX a whole lot. But back in like '07 and so forth, it's down like, again, 9. You're like, oh, that was wonderful. Okay? It was brutal. Because, the thing is about volatility, it's all relative. So just bear with me for a second. I want to say it's all relative. Here's the VIX for a long, long time. Here's where I started trading. I started trading, and the VIX was always above 20. If it dipped below 20, it was only for a matter of days. Okay, and then we came into this area where the VIX was down for a long period of time. You know what this was? Okay, for those of you that want to know a little bit more about volatility. Okay, so right here. Okay, was, ultimately the internet age, volatility was coming into play here. Okay, this was what I call efficiency. This is incredible efficiency in the market. And the efficiency was a huge amount of algorithms started trading. A lot of that actually started, in the late 90s, early 2000, but it took quite a long time because there was huge volatility from 2000 into this area. Okay. Then we came into this area of efficiency. Efficiency was computers that were able to trade sub-second. Okay? It makes the market that much more efficient. Things become ridiculously efficient, right to the point where they snap in your face. Okay? Right now, markets, they're efficient again. Okay? And they might be efficient for a period of time. And the more capital that's out there chasing returns, the more efficient markets actually become. But they're throwing off warning signs of volatility right now. Now, when I say it's all relative, when the VIX is trading down at like 9 and 10, it's the lowest VIX, and I actually remember precisely the day that this occurred. So, because I'm completely and totally nuts. But when VIX is really, really low, trading a stock with a 20% vol can be quote unquote considered volatile. All right? So, where volatility is overall in the market kind of does play into a factor of like what you consider high volatility and low volatility. Apparently I just screwed up my left side bar over there. That was hideous. Anyway, I fixed it like I've played with this thing before. All right. So onward and upward over here. The next thing, so we kind of know what we can use this to gauge risk on. And there's one last thing I want to tell you about in terms of gauging risk. So let's pick a stock. Let's pick a stock, though, other than Netflix, other than Apple, other than something that's on our radar screen every single day. All right. So you want to look at these volatilities typically in stuff, that's liquid. All right. By the way, Brian, yes, I was with Think Pipes on the institutional side of the business for First Solar. Thank you. So First Solar, it's not as wild of an animal. Here's what you're going to do. You're going to go out, you're going to do a trade on First Solar. Let's assume that you're going to do an options trade. Now, if you traded stock, stock we'll come to in a moment. But you're going to do an options trade. I'm going to actually put this first. Again, one of the first things that I implore you to look at is expected move. So whatever date that you select, whether it's 30 days, 37, 23, whatever date you select, look at what the expected move is. Make absolutely sure that whatever your trade is, that the expected move goes with it. And you're like, I don't get what you're saying. If you're doing a trade for, let's say, 44 days. Okay, I'll use 44 days. Why? I don't know. I felt special. If you're doing a trade for May and there's 44 days, there's a $9.50 expected move. Which basically means whatever trade you do, whether you buy options, whether you sell options, whether you do a little dance, make a little love, get down tonight, it doesn't really matter. It's got to fit the expected move. And you're like, still not really getting it. This is a $68 stock. You go out and you buy the 70 calls. 70 calls are trading for almost $2. That means you need to just be at 72. 72 really kind of break even. That trade, it's terrible. People do this. It's terrible. It's outside the expected move. We're only expecting a $9 move. Probability that you just put yourself in by buying these calls, brutal right off the bat. That's the kind of thing I'm talking about. Okay? That's why, like, I really pick on, like, you go out and buy some calls over there. Yeah, you could make a boatload of money. But if you do it again and again and again and again, you realize the market is telling you, we ain't going to be out here. We ain't going to be out here, buddy. There's only 70%, 17% chance. You should probably listen to the probability. Expected move, probability, volatility, they're all the same thing. People look at price too much. Who cares what the price is? It's all about probability, because probability and price, they're synonymous. Probability, volatility, and price are actually all the same thing. This option is trading for $1.93. Why? Because it only has a 23% chance of being in the money by expiration. Okay? There's a reason for everything. There's no like weird assignments. This is not some like crazy calculation that's just pulled out of a hat. It's a hat. All right? And they pull out the volatility and pull out the probability. This is the probability of being in the money. All it does is takes this price and converts it to probability. That's it. Nothing more, nothing less. So first thing you got to do, if you sell an iron condor, what's selling an iron condor? Okay? It's one of these little guys where you go out and you go, okay, and you look at the expected move and you sell crap out here and you sell crap out here. You better make sure whatever you sell is probably outside the expected move, because 68% of the time we're going to be in this range. Okay? That kind of stuff is helpful. So for options, make sure your expected move kind of jives with whatever you're doing. Number 2, stock. Let's talk about stock for a second. Okay? This, to me, I love talking about this when it comes to implied volatility. And this is, again, where I used to beat up lots of traders. Okay? If you're going to go out and you're going to trade stock, which, just out of curiosity, how many of you guys are going to trade stock? Anybody? 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 How many people do just go out there and buy and sell stock? I do all the time. I trade stock all the time. Intraday, I'm way more likely to trade stock than I am options on an intraday basis. So if I put a trade on, take it off, I trade stock like it's water. I trade a few hundred shares here, a few hundred shares there. I just trade it all day. And just like fire, a couple hundred shares here, a couple hundred shares there. For most of you, though, it's not efficient because you don't have a commission schedule. The more you trade, the better deal they give you typically. All right, I'm not supposed to say that, but the more you trade, the better deal you're going to get because, well, you trade a lot, I try to do a few hundred trades a month. I'm not crazy. Like, I don't do 1,000 trades a month, but I do put on a lot of contract size. Anyway, it's probably more efficient for you guys to trade it. So, some people, sometimes, yes, stick to options, do covered calls. Cool. All right, perfect. Okay, so most of you do. When I win the lottery, right, what are the odds of that? So the odds of actually walking down the street and literally falling face first into a trunk of $100 million of gold coins has a substantially better probability than winning the lottery. You're like, he just ruined my hopes, my dreams. I know this sounds kind of strange, so I am now officially 40 years old. Okay? And to every one of you, I have never in my life purchased a lottery ticket, ever. Okay? I've never purchased a lottery ticket. I refuse. Okay? Nobody in my household will ever purchase a lottery ticket. Why do I say this? Because about 1.5 miles away from my home is one of the largest, winning lotto ticket buyers in the history of the lotto. So, ticket was actually purchased at a gas station just about 1 mile away from from our home here. And, I'm in the gas station like, I don't know, we get gas there all the time. When I can't make it to Costco to get gas, we get gas there all the time. I'm in there, out of there, okay? I actually don't ever really walk in there because I just use a credit card and get the hell out of there. I'm not pick up the local beer kind of guy. But anyway, I stop there all the time. And my wife always reminds me, she's like, you're just an idiot. And I'm like, why? Because even if we had bought it, we still wouldn't have won. She goes, yeah, I get it. But anyway, I like it. Somebody said, just turned 60 last week. But isn't 60 like the new 40, which makes 40 like the new 20? So Yeah, it's going to be hard to explain to my kids because by the time they are 20, I will be 60. Anyway. And then by then, 60 will be the new 20 because apparently we become that much more immature as time goes on. I'm buying into that crap. Anyway, if you trade stock, use the expected move. Don't even worry about like vol. Sometimes just use expected move. And this is what you want to do. Okay. Anytime that you trade stock. And again, one of the things that I really want to make, I want tangible like stuff out of these sessions. When I say tangible stuff, okay, out of these sessions, I mean like I want you to be able to leave here and actually have stuff you can use, right? So here's a $62 stock with, let's say you're going to do a trade, and the trade is going to be for the next 44 days. Like most of the time when you get into a trade, you define it. Just look about a month out. 44 days is fine. There's about a plus, okay, or minus. Let's just round it to $10. Okay, so there's plus or minus $10. And again, you have to use expected move to allocate. So right over here, okay, plus, okay, or minus $10. Now, you go out and you trade a $62 stock. It's expecting over the next 44 days a $10 move up or down. Can you handle that? So this is actually what I used to bring up to, these registered investment advisors. I go, what's your puke point, sir? And they go, what the hell is this guy talking about? I go, hey, listen, you're expecting a $10 move. You better know that, which basically means if the stock goes against you, okay, you can't just set your stop order wherever you think you're going to set it. You're going to put it at 60. You're getting stopped out, buddy. You're getting stopped out. You got to be able to put the stop order, okay, a lot of times to the outside of the expectations. So you got to be able to eat $10 of risk, and that's 68% of the time. An abnormal occurrence would be what they call 2 deviations. So that equals 1 standard deviation. 2 standard deviations, 95% of all occurrences, is plus or minus $20. Have we hit your puke point yet? Because this stock can actually price all the way down to 40. If you trade 1,000 shares, ladies and gentlemen, you better be ready, minimum, to take a $10,000 hit. Correlate what? Okay, and calculate expected move directly into profit and loss. With shares, it's so easy because you just go, well, if it says plus or minus 10 and I trade 1,000 shares, I'd be able to, go out there and plus or minus $10,000, right? But in an abnormal occurrence, something happens out there, CEO, something happens to him, oh no, you're going to plus or minus $20,000. It's one of the most effective ways to use implied volatility. Now, time out over here, okay? So we've talked about, again, a little bit about implied volatility. How can you actually use it, okay? Now we're actually going to dig deep. When you look at something like First Solar, all right? And again, the last 10 minutes over here, this is going to start to get, a little esoteric. I'm going to take a direction over here. When you look at something like First Solar and you look like, yeah, man, volatility is high. Yeah, it's high in First Solar. Is it? How the heck can you know if volatility is high? You can go over to a chart. Here's a chart on First Solar. It's a 20-year chart, right? Here's a chart on First Solar. And I'm just going to pull up the last 9 months. There's 9 months. It goes up and it goes down. It goes gap. And then it goes gap, 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 gap. All right? This is just a gap-filled wonderland. This thing's uglier than it is Netflix. So you go over to studies, and you can go to add study and come down to like volatility studies, and you can go over here to implied volatility. And the implied volatility, you know what you find out when you look at the chart of implied volatility? Volatility is actually not that high in there. Volatility can get a lot higher. Okay? So what you do is go over to the trade tab. You never have to look at by the way, looking at the chart, we don't need no stinking chart. All right? Go over here to the trade tab, open up these option statistics. Now, this is something that is on Thinkorswim. I don't know if it's on other trading applications because, I can't look at other trading applications because if I do, the shock collar goes off. They come into my house. They drag me back to Chicago. They put me in cement boots, and I go into the Chicago River. That's what's going to happen. But if you are on Thinkorswim, okay, you can use what's called an IV percentile. What an IV percentile does is it looks at the 52-week high implied volatility, the 52-week low implied volatility, and it says where we're currently ranked. So basically, if you looked at a chart and it goes down here, and it falls off over there, and this is the chart, okay? the middle of the road would be right here. Where are we right now? 44% implied volatility. So we're somewhere down here, right to the lower end, assuming that this line in the middle is the 50th percent. Up here, this would rank us at 100. Down here, this would rank us at the 0 percentile. It's a percentile, okay? So what it means, right, is it's not really a percentile, it's a ranking, but if it means we're at first, okay, the 10 percentile, that means volatility is very, very low on First Solar versus the last 52 weeks. So what it does, it actually gives you an idea of where volatility is unto itself. Let's go back over to Apple for a moment. Okay, so you go back to Apple, the volatility percentile is the 23rd percentile. It's still very, very low. Okay, we go over to our friend Netflix. Okay, now by the way, Netflix, so it's sitting, okay, at a volatility of about 57%. Irony is that's exactly the middle of the road. I time out Netflix. I have actually watched Netflix since before they were public. As crazy as that might sound, that's a company that I've actually followed since almost the inception over there. Okay, did I own the stock? No! I just mention it because it's an underlying that has had some of the most wild volatility moves. And the only reason that I ever tracked Netflix and I was interested in this company, okay, I've always been interested in Netflix. The venture capital firm that had purchased, okay, part of Thinkorswim back in the day was the same venture capitalists that actually bought into Netflix. Okay, and obviously they took both companies eventually public. By the way, the best part of that story, they took the companies public. Then they sold out of the stock when the company was public. They exited because that's how, that's what, these firms do. They exit. And then they took most of the money from those two successful exits, and that was some of their more successful exits. They took it, and they were like in one of the first rounds of Facebook. Oh, man, that just did it for me. Yeah, they really were. They were one of the first rounds of Facebook over there. So it was like a Silicon Valley like dream story. And the only reason I ever followed Netflix is because one of the venture capitalists was literally yelling during a board meeting. He's like, this is the worst company. He was talking about Thinkorswim. This is the worst company we've ever invested in. And his partner goes, no, that piece of crap Netflix is the worst thing. Guys are like the same. By the way, they exited both of those very successfully. I love that story over there. It's good insight to the marketplace. But implied volatility percentiles, they can kind of be used, right, to give you, again, a feel of where vol is. Is it middle of the road? Because that's where Netflix is at right now. Or is it towards the high end of the road? And in just a brief moment, you could figure out like how to scan by this stuff. It's actually under the Scan tab, Stock Hacker, add a study filter, okay? And it's under volatility, and you can actually scan for IV percentiles. And you can say, again, I'm just going to scan in weeklies. I want to make this clear. I'm just going to scan in weeklies, and I want to scan for something that has extreme volatility, but not like people look for like high volatility. I'm not looking for high volatility. I'm looking for high volatility, okay, unto itself. And what that ultimately means, look, there's only 3 underlyings that came up. This is a list of 400 different stocks. EWZ, you guys know what that is? All right? In Brazil. So it's Brazil. And Brazil is sitting at a 90th percentile in terms of implied volatility. That usually means that stock, okay, is feeling the risk right now. Oh, yeah, I like it. Okay? It's pretty amazing the fact that it's sitting in 90 percentile and it's actually rallied quite a bit. But every day the volatility has been kind of creeping up over here. So keep it in mind. By the way, the volatility back over here, that was August 24th, 2015. So this is pretty much the highest volatility. So again, to look at the scanner, pretty sweet little tool over there. And these other stocks are like $2 stocks, so we don't need no stinking stocks that are $2. Should also come in here though and quickly just gauge where's the S&P 500 at. Only one stock in the entire S&P 500 has really high freaking volatility unto itself. When I say high volatility unto itself, it's CarMax, 92nd percentile. I'm going to tell you why this has high implied volatility. Because it's actually pricing, all right, still a little bit of earnings coming up, it looks like. Because the earnings, all right, are coming out, it's actually jacking with the implied vol. So that's it. Nothing else. Now that alone, forget about like, let's look for some trade opportunities. You want to know trade opportunities? The entire market right now is screaming, we don't have very high implied volatility. You don't just scan for like IV because it doesn't help you. Scanning for implied volatility percentile, though, it's smart because it tells you now the entire S&P 500, okay, isn't trading at a high volatility range. Let's knock this, okay, down to 80 and hit scan. And in an instant, okay, 2 underlyings come up. Now you're like, holy crap. Now let's actually knock it down to 70%. Scan, okay, only 10 underlyings. Markets right now, rock bottom volatility. Why do you think that's important? Because that's typically what you get is this unbelievable complacency right before we get shocked by vol. Now that unbelievable complacency, okay, can last for sustained periods of time, but you're not getting paid very much out there to sell option premium right now. So the way that you look at this, allocate gingerly right now. It means don't put a huge amount of capital to work inside of a low implied volatility environment. Okay, when you're trading options and specifically selling options, when the entire S&P 500, barely any of the stocks are jacked up, do you realize everything has earnings coming out? These are being influenced. Of these 10 stocks, they're all being influenced by the fact the earnings are coming out. That's why the volatilities are up. So the reality is, okay, nothing is even trading in here. I bet you can go to the 50th percentile and you're still not going to see a lot of stuff trading, okay? And there's 78 different stocks. Look at this, earnings, okay? And earnings are actually driving the volatilities a little bit higher. But it's amazing to see that. And that's why I like to look at the weeklies, because the weeklies help me, because they have weeklies out there that, have, again, weekly options, 66 underlyings in the weeklies. And some of these are ETF products. It's good stuff. Cree. Yeah, I bet that has high implied volatility. That thing got slaughtered today. All right, Chipotle. Couldn't have happened to a better burrito. That are some of the most effective ways to actually use implied volatility. Now, in future sessions, okay, I like to keep, things to time, but in future sessions, then we're going to go ahead and we're going to start to use implied volatility. Okay. By the way, the vol index is actually a 30-day VIX style implied volatility. So if you ever look under options statistics and it says implied volatility, that is the vol index. Okay. The vol index is, you must have found that under the scan tab. Okay. It's under add stock filter. It's called the vol index. The vol index, what they do is they take options, okay, averaged out for 30 days to come up with a volatility index. That's ultimately how it's the same equation as the VIX, and that's what it is. All right. By the way, why would the IV double, okay, in a particular expiration? The answer to that is if one implied volatility is double the other, it most likely means it has an earnings announcement. So that's it. Okay. It's just an earnings announcement. That's more or less the reasons. So somebody said LNKD, LinkedIn. What does LinkedIn do? Like seriously. Oh, LinkedIn is actually a great one. Look at the earnings on this thing. Okay. That is a wild animal. So all of a sudden it jumps to like almost a $20 expected move. What? That's ridiculous. $20 expected move on $114 stock. So that could hurt. That's going to leave a mark to somebody, right? And let me tell you, when it's pricing in this much and nothing prior to, it just basically means, okay, get ready for it. Wait for it. Because LinkedIn, they had a little issue last earnings. A little bit of an issue. They were here, and then they were here. Now, they haven't moved since here to here, because now they're here. Nobody will touch this stock until the earnings are out. They just won't touch it. This was like the most in-play stock, and now they're like, no. We've decided against it because what ultimately happened was like this ridiculous, 3 standard deviation move. And that's how people get crushed around earnings. You sell options naked around earnings enough, and you get hammered over there. It's a warning to you. All right. Dennis, what level of skew? So that's skew is a whole different story. But when it comes to skew, the ratio of butterflies, you want to look for those in major index products such as the spiders and so forth. When you start getting skew upwards, okay, of like the 130 range, when this skew is up to like 130, fire at will, sir. Okay. Now that doesn't always happen, but it was advantageous for a long period of time. The skew hasn't been wonderful lately. It's been pretty surprising though over there. So, all right, by the way, the video that I did tonight, I did do a video. One of the things I wanted to point out, the XLF didn't move today. So the market today was led by healthcare. That's an exciting one. And energy. Those are the two sectors that actually drove the S&Ps higher today. Had nothing to do with Yellen. Healthcare, okay, and energy actually drove us, specifically biotech. Biotech is up over 7% today. Pretty wild day over there. So I want to thank you guys for joining us for the what we were calling, formerly known as the Wednesday evening coaching session. Okay, because it looks like now we're calling it, the options happy hour, or we could just call this the, Theo happy hour. So Theo is quite happy. So the Theo traders happy hour. I like it. I want to thank you guys for joining us tonight. We do these things because some of you guys do, you're working during the day, can't necessarily join us. Hopefully we answered a couple of questions over here. For those of you that don't necessarily tune in, we're doing an Options 101. Options 101, the basics and beyond. We're doing it, it's a 5-part series, been on all this week. That's the coaching session. It is found in the archive right now. Parts 1, 2, and 3 are archived. Obviously, part 4 coming tomorrow, part 5 coming on Friday. Okay. These Wednesday sessions, we're going to start to list the topics substantially earlier. Okay, so you can kind of tune in, turn on. I like to have topics to the Wednesdays because these are almost like mini classes. I like bite-sized pieces of information. It's hard to sit through a 4-hour class. Nevertheless, we archive everything. So hopefully you guys enjoyed some of the in-out spreads class. If you haven't seen it yet, it's in the archive as well. Everything's in the archive. That's why we do Total Theo. Anyway, guys, need anything, let us know. Thanks a lot, everybody, for joining us tonight for, again, the Wednesday Theo Trade Happy Hour. Have a great night. Bye-bye.